Hello, dear eTorians. This is PC here from GlobalAlphaS. We just finished September, so it's time for my monthly portfolio update to you with some more talking about the views and what has been happening and what I think will happen in the markets. And it's not been an easy one this month again. So let us just move on to the presentation. I will present you my screen. All right, so I've chosen an epigraph called Stubborn Inflation, Stubborn Fed this month presentation, and this has mainly to do with the fact that the inflation metrics are indeed showing signs of stubbornness. And it's really about the sticky inflation, because the headline inflation is indeed going down right now over the last couple of months, but the problem is now with the sticky inflation release, which is much more dangerous than the headline one, obviously, because of its characteristics, right? And as stubborn as inflation is, so stubborn is the Fed. We have had quite a bit of things that has happened again over this month in terms of the Fed's attitude towards markets and their basic objectives. So let's just move on. I will talk about all that in details as we go through the presentation. All right, so let's just kick off with a portfolio overview quickly. In the month of August, S&P was down as much as 10%. So we again hit another month of extreme downside volatility. And it was not really only about stocks, but treasuries got hit again just as much as the stocks did. Actually, the long-term treasuries were hit as much as 9%. Even gold was down, so pretty much nowhere to hide this month again. And most of the asset classes were under extreme pressures because of what was happening with the rates, with the strength of the dollar, and some other stuff that we will just touch upon in a little second. Our synthetic internal benchmark was down 8.5%, and our portfolio was down 5.7%. So we again outperformed both our synthetic internal benchmark that we have created, that is cycle adjusted, and we also managed to outperform the S&P 500 index again because of our positioning, right? On a year-to-date basis, S&P is down as much as 25%. Our synthetic internal benchmark is down almost 24%, and our portfolio is down 15%. So even though we're down, which is not a good thing, obviously, we do produce alpha versus our synthetic internal benchmark. And for those who like to compare against the equity indices, we are having a positive alpha here as well. But as I have said many times, S&P 500 is not our benchmark. It is the synthetic internal benchmark that we really compare to. But for those who like to watch and see how our portfolio performs versus equities in general, I do also provide the comparison to the S&P 500. The portfolio composure has not changed much. The equity allocation has decreased a little bit. This is mainly because of the fact that stocks were down this month, right? So that's pretty natural. Pure equity portfolio, pure equity allocation at the end of the month was 42%, and with our SPLV ETF, it was around 50%, which is pretty much in line with our equity benchmark for the boom phase of the cycle. Sorry, it's actually above by 10 percentage point, because our benchmark is no, it's actually 50%. Sorry, it's 50% for the for this cycle phase, right? Cash was 40%. Risk remains very stable at 4%. Our volatility is relatively stable at around 2.5 to 2.7% daily, which is a good thing given the extreme volatilities in the markets in general. These days, our portfolio is hugely skewed towards value stocks, and we're underweight equities in general versus a fully invested S&P 500. Of course, so our volatility is naturally lower than in the case of pure equity portfolios. We have made no reshuffles this month, so the portfolio looks exactly the same as it did a month ago. I just do not see any reasons for my portfolio to be refurbished these days. We keep staying underweight treasuries. We do keep staying underweight gold, and we are at the benchmark in terms of equities. So all in all, this still adds alpha into our portfolio. In August, we outperformed the SIB by 2.8 percentage points, and we outperformed versus the S&P 500 by over 4 percentage points. And the reasons are pretty much the ones that I have already mentioned. So less than benchmarked equities, bonds, and gold. It's actually equities at the benchmark and less than benchmark in bonds and gold. On a year-to-date basis, our active return also looks relatively good. We do outperform both the SIB and the S&P 500 by between 8.5 to 10 percentage points. And the reasons for the outperformance is pretty much still the same. So we did great in the first quarter. That's one thing. And we do stay underweight in Tilt and GLD. And our current equity allocations or allocation of around 50% does add alpha versus the S&P 500 and is neutral versus the SIB, given the fact that our weight in the SIB for equities is now percent, as I have already said. The major drivers in September, pretty much most of what was happening in September started at Jackson Hole at the end of August already. And just as Jackson Hole buried the dovish Fed pivot camp this September, did only provide more reasons to be thinking that this is the way it's going to be right now. And seriously, the Fed did everything they could to make the markets believe that they are not going to pivot, and they are going to stay as dovish as they can until they do get inflation under control. The September FOMC brought another 75 basis hike and gave a dove-killing message of higher for longer rates. In more details, it was all about the dot plot being up by over 100% pretty much across the curve. No rate cuts in 2023, so first rate cuts are now expected only in 2024. The end of year 2022 Fed funds moved from like 3.8% to as much as 4.4%, and the terminal rate, which is expected next year, is now as high as 4.6%, which is way into restrictive territory compared to what the Fed considered restrictive territory yet a couple of months ago. The Fed speakers were very happy with the market reaction as a rule, which we should read as the Fed is aiming to achieve maximum aggregate demand weakening by targeting the wealth effects. So naturally, this is being done by lower stock markets, but it's not only stock markets that are getting lower these days. It's also the bond markets and some credit markets. It's the FX that is being extremely volatile. So it's a mixture of many asset classes moving into different directions in a way that is unpredictable, highly volatile, and is causing a lot of collateral destruction. Just as the Fed was behind the curve in 2021, it is now being said to be way ahead of the curve, and many analysts and commentators are saying that the Fed is risking another big policy mistake and might push the economy into recession. Although, at least what the Fed is saying is that the soft landing is still their base case, but they are not excluding recession at all, just as they did exclude recession yet let's say half a year ago. The message is we have one mandate right now, and this one and only mandate is to get inflation under control. Inflation metrics are on a downturn in the non-sticky areas like the gasoline and some other headline moving parts of the CPI, gasoline obviously being the first one. But the problem right now, and I think the problem that the Fed sticks their attention mostly to, is the sticky part. So things like housing, things like medical and personal care, and some other similar parts of the CPI basket that do not really change up or down that quickly, but they are on an uptrend right now. So it just the thing that they're sticky just means that it's not that easy for them to move lower relatively quickly, just as it can happen with gasoline, for instance. And yeah, the sticky part is basically the part that is causing the aggregate inflation data surprise to the upside constantly, and this is the biggest problem that the Fed has right now, and they want to kind of kill it as much as they can, and that's why they behave so hawkishly. No mercy for most of the assets, stocks, bonds, FX. They are all in gigantic volatility burst in September. They have been. And it was pretty much the market that shows no place to hide. Every single asset class has their big losers. And unfortunately, as we finish September, we're pretty much in a situation where liquidation and redemption selling is being seen everywhere. It's not only in stocks, but also the treasury markets. The extreme volatility is on the downside. It's just causing big collateral damages pretty much everywhere, as I said. And this means that many investors have to liquidate and cannot really keep their positions. The fears of global recession have increased again. I think a recession cannot be excluded at this point. And what happens from here on with the Fed's attitude towards the inflation readings is going to be extremely crucial in terms of whether we are going to see a Fed-induced recession or not. Quick Fed overview. As of August, we already saw a hawkish Fed, especially after the Jackson Hole, right, when they did underline that they are not going to pivot. We got a 75 bips hike. We basically got a message that we should not fight the Fed from some of the Fed members. Mr. Kashkari was the first one to say that he was actually happy to see markets down, equity markets down after the Jackson Hole speech by Mr. Powell. And rates were higher in August, and the Fed wanted them to be higher until they get confident with inflation. But in September, we only saw the Fed being even more hawkish. we did get yet another 75 basis hike. We got a dot plot move much higher, as I have already described, and not only it moved higher, but it's from what we see right now, it is going to stay higher for much longer than previously anticipated. The Fed does not exclude recession because of their deeds, but as I said, the basic scenario is yet soft landing. Inflation is obviously their only mandate, and quite a bit of negative happened in their economic projections that were published during the last FOMC meeting compared to the last ones that were done in June. We saw a lower GDP growth for 2022 and 23. We saw higher unemployment rate for this year and next year, and 2024. We saw higher PCE and core PCE for this year and next year, and we saw on aggregate higher Fed funds rates for this year, next year, and 2024. And on the next slide, I just quickly wanted to show you those new economic projections, which do clearly show that right now versus the June projection, we do see a big change in the expected real GDP. For instance, for this year, you see the former projection was in terms of central tendency between 1.5 to 1.9%. Right now, it's only 0.1% to 0.3%. So this is pretty much a flattish GDP year on year, which is very, very close to recessionary tendencies, especially given the fact that last two quarters were actually already quarters with the GDP being down. So like technically we are in a recession already. But obviously quite a bit of things that were negatively impacting the GDP growth in the first half were coming the Russian invasion on Ukraine. Next year's GDP central tendency also lowered from 1.3 to 2% to 0.5 to 1.5%. And on the other hand, we see unemployment being expected to be higher than previously, PCE to be higher than previously, core PCE to be higher than previously. And as you see here, in the lower part of the table, we also do see Fed funds expecting the their Fed funds to be on aggregate higher this year, next year, 2024, and the terminal rate to be higher, quite substantially higher, actually, from 3.8% to 4.6%. So they are now way into restrictive territory, and the question is whether this is going to be the major reason for either US or even global recession. We're talking about potential global recession because the extreme strength of the dollar has been causing a lot of problems all around the world with currencies of other countries, with inflation being pretty much exported from the United States everywhere outside, especially into the emerging markets economy. Quick look at US inflation tendencies. Again, the sticky inflation is the problem. Last month, we saw 3 out of 18 major indicators to be showing signs to be higher than the previous months. And right now, again, a worse aggregate reading. So 7 out of 18 inflation goals are higher than last month. So as you see here, inflation problem is not over. Headlines are falling, but headlines are constantly showing reads above consensus. This is the biggest problem, and yet they are coming from a sticky part of inflation basket, which is very problematic for the Fed. Commodities, the clear positive tendencies here. As you see, gasoline was up 24% year on year in August, and right now it's up only 5% year on year. So good things happening in this space at least, and obviously we have to nod on those tendencies and keep fingers crossed that the winter is not going to cause another spike in the oil prices and the gas prices although obviously gas, especially in Europe, is going to be an extremely touchy issue with what has been happening lately with the gas supplies, with Nord Stream leakages and all that kind of stuff. So we do want to stick our attention to tendencies here as well. But for now, some positive signs are seen in this space, which is a good thing. The sticky part of inflation. This is the problem right now, as you see here on this graph from Federal Reserve Bank of Atlanta. You see two parts of inflation here in the long term, and the sticky one is basically the one that is rising right now, right? That's the red line, and the black line is the flexible inflation, which has started to show signs of a pivot a couple of months ago, and it's falling right now. But I want you to stick attention to those yellow colored moments in the history. As you see here, the moments that were the non-sticky inflation is basically crossing the sticky inflation from the upside are usually the moments where we see recessions and where recessionary macroeconomic environment persists, and we saw that in 2009, we saw that in 2001 and 2 after the internet bubble crash, and we also did see it during the recession at the start of the 90s. So given the fact that the non-sticky inflation is falling right now and the sticky one keeps rising, we will most possibly reach a moment sometime in the future where those two lines converge again, and it is yet to be seen whether this will be called inflation or this will be called recession or not. Forecasts and expectations, not much change. We're still in the boom phase. Coincident indicators are still not showing signs of a cycle peak ahead. And in terms of conclusions and my personal views, I do think that the probability of a Fed-induced recession has risen quite substantially over the last month. Should they not pivot into the phase of plunging consumer sentiment, extremely strong dollar appreciation, exporting inflation outside of US, and more and more dysfunctional markets. As we finished the day yesterday, during the last day of trading day of September, liquidity markets closed at their current bear market lows, and pretty much so did the markets for equities all around the world. The labor market stays extremely strong, but the Fed does look to break it to tame inflation. In their latest projections, they have moved their expected unemployment rate from 3.8% to 4% next year. What's going to be interesting is the Fed's reaction function to the crucial to the unemployment rate once that starts rising eventually. History shows that the reaction function of the Fed was very, very strong once unemployment was rising, and it was strong in a way that it caused most of the times the Fed to pivot and start decreasing rates to obviously help the unemployment rate go back down again. The equity markets are making new bear market lows. I have already said that. I do plan to stay underweight in Tilt and GLD. I will mostly keep my value stocks as I did over the last month. I might look into playing some tactical bounces, but for that to happen, I do need to see a trigger, and in my view, the biggest trigger is basically going to be the Fed's message. For now, it's extremely hawkish, and I don't think there's a reason to be chasing stocks. And the last thing to mention yet is the Russian escalation in the war against Ukraine and the rest of the world, pretty much. This has been only increasing, and I think this poses another very big risk to the overall situation in the market. So thank you again, and I'll hear you in a month. All the best to you. Thank you.